Good morning. The old man here. May 23rd, 2025. Yeah, I know I've been missing in action for a while. Spring's been really busy. Update from the last video. We did butcher that hog. It went extremely well. And I'm super pleased with the meat. We've been into it already. And I overall think that was very successful. It seemed a little expensive in some ways, but in other ways I think it was a great learning experience. I believe that hog was around a couple 100 pounds, and it would have been better if it could have went to about 250, but at the end of the day, I think it was a pretty good experience and a pretty decent value. I still haven't butchered the roosters and the drakes yet. Been super busy, need to do that. I've hatched some chickens or some chicks and got more in the incubator. I tend to get about a 50% hatch rate. Not really sure why that is. I think it should be better. Last year pretty much had the same thing, but at the end of the day, I guess it's all right. I've got my hens and roosters back from my sister-in-law, giving me more roosters to butcher that haven't got around to yet, but it's coming. Been trying to purchase a cow. Started back in November, looking around, got a date of February, or not a date, but a tentative February, and that turned into March, turned into May, or April, and then turned into not at all. He kicked the can down the road to September, and I'm not waiting until September. Found another farmer that wanted to, that we were able to butcher or purchase a cow. We've got a time frame of May. Here we are, 23rd May, and still don't have a cow. I got a feeling that one's not coming through either. Not exactly sure what's going on, but I think what's going on is there's quite a bit of demand at this time for locally grown beef. And I believe what most of these farmers do is double book or thereabouts, and figuring that a certain percentage of people are going to back out at the last minute. But this year they're not, or not a significant amount of people are backing out. They're getting prepped. I don't know. We'll see. My look at it is I've got the money set aside for a cow, and if that doesn't happen this month, I'm not waiting any longer. I'm going to look for some major beef sales, whether that's mostly Hamburg. I've got a lot of use for Hamburg, or I'll just buy it, get a best price I can on some roast, and can some of those. I've got a pretty good amount of chickens right now, a good amount of turkeys, so I think I'm going to concentrate on the beef. I've got a fair amount of pork in the freezer due to that one pig, but I'm looking forward to doing that again. Not sure when, where, why, but I do definitely plan on doing that again. An update on stocks and bonds and gold and silver, if you will. The markets are looking pretty shaky. I know the stock market took a pretty significant dump. What was that, around the first week in April? And it's come back most of the way, but that is what they call a dead cat bounce, in my opinion. And what does that mean exactly? Well, that means the big boys that have been holding on, trying to get as much out of it as they could, as much upside out of it as they could, held on till the first big dump. And that 20% is a pretty big dump. Now they know that right after that, the average investor has been conditioned or trained to buy the dip. And sure shit, that's exactly what they did. All of your retail investors, or most will call, if you're watching any of these videos, they'll call it the dumb money, which is, it's kind of a shitty word for it, but at the end of the day, it's kind of true. Another way of looking at it is the uninformed investor, that goes more on emotion than they do the stats. You know, they're not really looking at the stats. They're not working with the fundamentals. They're just chasing yield and buying and selling on emotion. So they've rallied that back up, and you can watch some of these videos where guys are talking about selling into the rallies. In other words, they've moved a fair amount of their position way ahead of this, but they didn't want to get out entirely, just in case there's more upside. They want to get as much upside out of it as they can, knowing full well that when it tops or it rolls over, there's going to be, like I say, a 20% dip. And sure shit, that's almost exactly what it was a 20% dip. And at that point, I was listening to them guys, and they're saying, boy, I hope there's a rally we can sell into. And sure shit, there was. And the dumb money's chasing yields, not paying attention to the fundamentals. And they bought into that dip, and now they've got it just about back to all-time highs. It's not quite there, and it probably won't quite hit all-time highs unless the U.S. Fed, or the U.S. Central Bank, the Fed, starts actually printing money, outright printing money. At that point, it will hit all-time highs again. The question is, and that's really deceptive, when you see the numbers keep going up, you think you're getting somewhere, but when in reality, if the market's going up less than your dollar's been devalued, in other words, if the market goes up 5% and your money's been devalued by 7%, it's not going up, it's actually going down. But that's hard to see. I realize that. It's just a mathematical trick that they know they can use to fool the dumb money, or the consumer. Too many people are going to stay in too long. I know a lot of people are on the fence. I don't know if I've got any new viewers, or somebody that's on the fence and barely just kind of dabbling in this gold and silver thing. Well, in my opinion, if you don't do something now, you're going to regret it. The fact of the matter is, things are starting to unwind. My last video, I talked about when that stock market took a pretty significant dive, the 10-year should have had a lower interest rate, meaning people moved, or a significant amount of people moved from the stock market to bonds. And typically, they can go all over the bond market, but typically the 10-year takes a pretty good bite. I mean, there's quite a bit of bid on it. Quite a people buy the 10-year, and that actually makes the yield, or the interest rate, go down. That's what it normally does. I can't say that's what it's supposed to do, but that's what it normally does. That's what people expect it to do. It didn't. It went up. Okay, and then over that weekend, it came back down again, which means, in my opinion, I said it right away, that's not good. That means that over the weekend, central banks printed money, just another way of doing it. They went in and bought that bond market up and brought the interest rate down again. Again, giving a false sense of security, thinking, oh, okay, shit, everything's normal, no big deal. If it takes another dip, we'll just buy more bonds, blah, 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 blah. When in reality, they're buying the bonds. And since then, the bonds are going up. I believe it's around 4.5% right now. And Bessent, if you listen to his interview, I think it was with Tucker, but he was interviewed by somebody. And they asked him, what keeps you up at night? What part of this is what your main focus is on? And he pretty much said it's not the stock market. What he's focusing on is the 10-year bond. If the 10-year bond gets 5% or above, we're fucking toast, is basically what he said. Go back and listen to that interview. You can see that interview online, and I'm telling you, that is a warning sign. And we keep creeping closer to that number. And even with their buying billions of dollars in the past week, they bought billions of dollars worth of bonds. It's just another form of printing money. It's making the dollar worth less. It's going to make gold and silver go up. Up in price, the value is still the same. I keep having to remind myself even of that. Gold and silver is going nowhere. It is a dollar losing value or purchasing power. And so every time they do it, it's going to get worse. Another thing I want to bring up is when Spain had the big power outage in the other countries, parts of other countries around it, but mostly Spain had a complete blackout. A lot of people panicked and realized, without electricity, they can't do shit. You can't buy anything. Everything's so electronic, and you can't access your bank. Bitcoin or nothing would have done you any good there either. And most people today, I don't know what about in Spain, but I gotta imagine it's pretty much the same as the U.S. Most people don't have cash. Most people are just using their credit card, or debit card as far as that goes, but they're not using cash, and they couldn't even buy anything. But with that being said, let's say you had a pile of cash today and the power went out and it was out for several days. You can't go to the gas station and buy gas because everything is electronic. You can't buy shit. So you better be prepared. Buy what you need ahead of time. But to elaborate on that even more, once the power come back on, people realized, oh shit, we don't have any cash. At least if we had cash, we can buy some things. So we better get some cash out of the bank. And there was enough of a bank run that they started putting capital controls on. And that's what you're going to see across the world. It's going to probably come to the U.S. last, but this can come awful fast. At this time, what you could see is something that affects another major economy may come here in 4 to 6 weeks. But as things get worse, that time lag is going to be less and less and less, and especially on a bank run. Because the problem is, with a bank run, if you have an actual bank run in Spain is not a major economy, it's a minor, if you will, minor economy. It's very decent, but it's still minor compared to, let's say, even Russia or China or the United States. And you're never going to get truth out of China, so nobody's going to pay attention to anything that goes on there. But, or Australia, let's say that's a pretty major economy. If all of a sudden there's a run on the banks in any one of those other countries, and or Japan, and Japan is coming apart at the seams. I'll elaborate that more in a minute. But if there's a major bank run or a bank run in any of those major countries, you're going to see that come here pretty fast. And what you might see is the bank shut down over the weekend. And then again, they might keep them shut down for the next couple weeks so that they can alleviate the panic, if you will, But unfortunately, much like the Depression when they shut the banks down to alleviate the panic, that was all more resolved that people wanted to get their money out of the bank. Okay, so at that point, what they can do is limit withdrawals. So if you're thinking you're going to wait for things to get really bad to buy gold and silver, or buy more gold and silver, or buy a significant amount of gold and silver, I'm afraid to tell you that when it gets here, you ain't going to be able to. You're not going to be able to move fast enough. That's why these major players have been getting out of the stock market, starting to get out 18 months ago, and more and more and more. Warren Buffett, he was out with Berkshire Hathaway. His trust, not let's call it a trust fund. I don't know. It's not a trust fund, hedge fund. When he started getting out, some people paid attention, but not enough people paid attention. They've been talking about it for a while now, and I've been talking about it for a while now. That should have been everybody's indicator. There is no value in the stock market right now. It's all overpriced. Every bit of it's overpriced. Was there more upside? Yes, but he has got such a large position that he's got to start getting out early. And realize it early. He's got paid for inside information. You can bet your ass he's got contacts in every major corporation, especially corporations that he's invested in. And when he's selling huge Apple stocks, huge the bank that he had a really big position in one of the American banks. I can't think of the name of it at the moment. Doesn't matter. But at any rate, he's selling huge positions in that. Jamie Dimon sold pretty decent positions in J.P. Morgan. Again, Bezos sold quite a few major positions in Amazon. And the reason for this is that they know that there's going to be a time to come and buy them shares back at a significantly lower price. But if you stay all in, you're going to lose a lot, and you're never going to be able to recover, or you're going to have to wait, for the next 20 years to recover, or at least 10 years, at the very least 10 years. But at any rate, the fact of the matter is the stock market is just barely propped up. I've always focused on the stock market. I've never really bought into the stock market, but I watched what was going on in the stock market, and I've realized in the meantime, especially over the last few months, or let's say year for sure, that the bond market is actually much more important, much bigger than the stock market. In fact, it dwarfs the stock market. And when there's troubles in the bond market, there's major troubles. And like I said, when that 10-year didn't get a bid, yeah, this country's in trouble. But not just this country. The world's banking system is coming apart. As all of these banks in the U.S. and across the world have got major U.S. bonds on their balance sheet, and hopefully you understand how bonds work. Maybe you don't. But when you buy a bond at a certain interest rate, let's say it's 3%, and the interest rate goes to 4% because the economy is getting worse, or the faith in the dollar is getting less, of which we're going through that right now. That's why interest rates are going up. But let's say that you bought a bond and the interest rate that was being paid was 3%. And it goes to 4%, that means your bond, if you need to sell it early, that 10-year bond, but you need to sell it like a year from now, it's worth significantly less because it's only giving you a 3% interest rate. So when it goes to 4, your bonds just took a shit. When it goes to 4.5, your bonds is even worse condition. So, if you're holding on to a 10-year and it goes to 4, you're thinking, oh crap, should I keep it or sell it? You know, and then when it goes to 4.5, you're going, oh my God. And if it ever goes to 5, Jesus Christ, I've taken a hell of a haircut on this bond that's supposed to be safe. And for the last 40 years, that was the thing to do. You know, they're doing a 60-40 portfolios with 60% bonds, 40% stocks. And the stocks are rolling over and the bonds have rolled over. They're not doing what they were doing in the past. It's a 40-year stretch. It's over with. The bond market, basically, it's not safe anymore. It's not providing a yield anymore. The only way for interest rates to go right now is up. Everybody's betting on them being going down, but they can't. They can't do it. They can lower the interest rates on the short end, but at the end of the day, the bond market's going to go up on the 10-year, the 20-year, the 30-year. It's going to go up. The only cure for that would be for the feds to come in and buy any 10-year, 20 years, 30 years that aren't sold. In other words, create their own market. That is a third world country, banana republic bullshit. But what that's also doing is making your dollar worth less. I hope what I'm saying is making sense. I think it does. At least it makes sense to me. What I'm getting at is if you've been sitting on the fence or you've been slowly buying gold and silver, you might want to pick that up a little bit. I know several friends of mine that don't get it. They've asked my opinion, I've given my opinion, and I know they still don't get it. Unfortunately, I think the majority of them will never get it. They will only chase gold and silver when it's unattainable, or it'll be so goddamn expensive, both from the aspect of the spot market, but also the premiums on it, because there'll be such a high demand and so little physical gold in coin form and bar form that, you know, such a high demand for it and so little available that they'll pay premiums that are twice. You know, so let's say silver goes to $35 an ounce, and all of a sudden, you know, some banks take a shit, and now all of a sudden, retail wants in. It'll go to, you know, spot might be $35, but to actually buy an ounce might cost you $70 per ounce. You know, and you're, no, that can't happen. Yes, it can. Yes, it can. Right in March of 23, their silver was around $20 an ounce. But if you wanted to buy an American Eagle, it cost you almost $20, not quite, but almost $20 premium to buy that silver Eagle. In other words, you could have bought an ounce of silver for, let's say, spot was 20. You could have bought an ounce of silver for 25. Ruger, shush. You could have bought an ounce of silver for 25, just like a generic round. But if you wanted an Eagle and you believe the Eagle was better than a round, that Eagle would have cost you about $38. So don't think that it's not going to be that way. Now is the time to start moving your position faster than you might think you have time. By the time everybody realizes what's going on, it's going to be too late. The big players already know where we're at. They already know where we're going. They're trying to come in slow, get out of certain things slow enough that nobody really, that the consumer market doesn't realize, or the dumb money doesn't realize what's going on. So they're getting out of stock slow, not buying the bond and buying gold in such ways off the COMEX, off the LBMA as much as they can, in order not to push the price of gold up. They're trying to buy at these lower levels, and they're doing a pretty good job of it. In fact, this dip we had here recently, I'm sure a lot of people, have gotten out of their position. They've sold even physical gold that they had, thinking, okay, it's made its run. That's it. I better sell it before I lose a bunch of money. And or people that were thinking about it go, oh my God, I'm going to wait to see if this comes back around. Well, they're going to miss this whole portion here where gold has been at a more reasonable rate. Some were calling for gold to drop as low as the 200-day moving average, which is about 2750, 2780 right now, something like that, even if you call it 28. And we've not gotten anywhere near that, and we're already starting to slowly go the other way. Nothing fast, nothing significant, of which is good. Gold is building a base. It had consolidated because it had moved too fast. People took profits. Gold came back a bit, but we're still way over where we were the 1st of January or the 1st of this year. So we're significantly over that. If memory serves me right, we were $2,700 the first of the year, and now we are playing around $3,250 to $3,300, and it doesn't appear to me that if we have a dip, even a deeper dip, I don't think it's going to be more than another $100 maybe. And even then, I really don't see it going backwards from here. We're going to have a little bit of up and a little bit of down, a little bit of up and a little bit of down. But the one thing, we're getting on to close to 30 minutes here, and I'm going to need to wrap this up to go to work. But one of the things I wanted to make sure everybody understands, number one, gold is not overpriced when you consider this money or stock market is going to roll over to the downside more and more. Like I predicted before, I think you're going to see it drop 20%, and then there's going to be, some people that buy the dip, and then it's going to drop it, it'll come up some, and then it'll drop 20% again. It might come up 10, let's just say for the hell of it, it comes up 10 and drops 20, comes up 10, drops 20. In other words, lower highs and lower lows, over the next few months. That'll keep everybody in the system long enough to lose more and more and more money. But with that being said, the smart players, the informed players, are going to buy more and more gold. They're not going to buy bonds. They're not going to buy into the stock market. They're going to buy into something that holds its value. And that'll be gold. The numerical figure of gold will go up, but the actual purchasing power will stay the same, basically. However, when you have stocks at all-time highs and a bond market that has rolled over and is heading, the yields or the interest is going to pay more, but the bond market is actually not going to be what it was the last 40 years. It's going to be the exact opposite, where interest rate keeps raising, and every time the interest rate goes up, like I said before, the bond is worth less. So at what point do you buy bonds? Not at this rate. Not to mention, who wants somebody else's debt? That's all that is the government spending more money, getting less return for every dollar. Back in the 80s, when they sold bonds, they took that money, invested it into the country, and they got like at least a 20% return on that debt, of which made sense. When you get a return that's greater than your interest by higher GDP, hell, that's good. That's a good investment. But nowadays, they spend $1 and they're getting 50% or 50 cents on the dollar return. That's a bad investment. And in fact, every time you do that, you're borrowing more to get less. You're going out of the world ass backwards, and that is not something that's sustainable, and it's happening faster and faster and faster. this big beautiful bill that they just passed, or I guess it just passed. It kind of sounds like it did. At least it passed the House. I'm not sure if it has passed the Senate or not. But if it has, there's another over 10 years. They're talking about $30 more trillion in debt. Oh my God. That means your dollar is going to be significantly worth less. Listening to Rick Rule this morning on one of his videos, talking about through the 70s, he's basically equating what we're looking at today is reliving the 70s, but only it's going to be significantly higher. But if you want to follow the trend, you'll get the right idea that during the 70s, the decade of, let's say, 75 to 85, the purchasing power of your dollar went down by 75%. That's where we're at today. That's where we're headed. Your purchasing power is going down. It doesn't matter how they print money, whether that's through actual, putting more liquidity into the system, or borrowing the government more money by propping up bonds or buying those bonds. It doesn't matter how they do it. That's going to create inflation. We're going to have another wave of inflation. I predict we will. That will mean that everything that you need will be significantly higher than it was before. Back during the beginning of the pandemic, I could see what was coming. Now I was ahead of the game a little bit, more than almost to the point where I was questioning my sanity. But I stocked up on a lot of things that I knew I'd use. I mean, I had like 30 or 40 2.5 or 3.5 pound coffee containers there that I had bought at much lower prices. At that time, I was finding it on sale for $2.50-ish, $2.60 a pound. And right now, the best price coffee is maybe $5, $5.50, $5.60. So there's a 100% increase in price on coffee alone over the last, from 2020 till now. So that's 5 years, 100% increase on coffee, and that's something nobody thinks about. I drink a lot of coffee, so I think about it. But other food staples and that I bought back then, I mean, I'm still working. I bought a bunch of rice and beans and whatever else back then. And I don't say they're 100% more expensive than they were back then, but they're at least 50% more expensive than they were back then. And I've used up a fair amount. I want to keep things rolling over. So, I'm going back into the market and buying more again, some to replenish my stocks, but also to increase my stocks of what I've got. And it's costing me 50% more than it did 5 years ago. It is what it is. I mean, I can only, even back then, I could only buy so much. I only got so much space and whatever else. And I think I'm seeing this. Oh, I know I'm seeing a second wave of inflation coming just by what's going on in the world. And they're going to print their way out one way or another. It doesn't matter how they do it. They got to print their way out. They're not, I don't believe they're going to default by just telling everybody, screw you, I don't owe you nothing. But I do believe they're going to print one way or the other. You're going to have higher and higher and higher inflation. With that, your portfolio on stocks might go up, the numbers might go up, but when you consider, again, like I said, if stocks go up by 10% a year and inflation is 20% a year, you're losing 10% of your purchasing power every year. But gold, for the last 25 years, has been holding its own. You've been getting roughly 9% over the last 25 years per year. A 9% increase, and I'd say through a good many of those years, your inflation was less than 9. It may not have been a lot less than 9, but it was less than 9. They claim maybe 2.5%, but I'm telling you, average is probably 7.5, and you were getting 9. That's holding your purchasing power and maybe gaining a little bit. In the future, as things roll over and go south, and that's common, you're going to see the purchasing power of gold go up, not only in dollar value, but you got to look at stocks that are significantly overvalued and you take them to being significantly undervalued. And that's just the way things normally go. They go from way too high to way too low. And if you've got gold, you can turn that gold into liquidity almost immediately and turn around and buy stocks at maybe 95% less than they are today. That's going to buy you a significant amount of shares. However, if you keep these stocks at their high values and you ride that son of a bitch all the way to the bottom, I hope you live long enough to see it make the top again. I don't think most of us will. I think it's going to take at least 40 years. So if you're 20 and you've got stocks, probably don't because of the way the shitty economy. But if you do, and you'll lose enough on them now that you'll never see them get back to where they were. You know, you might live that long. You might be 60 years old and see them get back to where they are today. So, like I say, if you're invested in the stock market, time is now to start to get out. Make sure that you're backed up by gold. You've got a significant amount of gold in your portfolio. If you don't, now's the time. You got to be ahead of this curve. I consider gold insurance, and right now your insurance is fairly inexpensive, even though it's $3,300 an ounce. It's still relatively inexpensive when you think of how things can go. All right. I hope this made sense. If you would, like and subscribe, and please leave a comment. I'm going to try to make some more videos, but the way things go in the spring of the year, I'm normally pretty busy. I'll do what I can. Thanks, guys. Have a good day. Bye.